Hello, I'm Joyce Barrett, and I'd like to welcome everyone to today's webinar. Webinars are brought to you by the generosity of the supporters and members of Heritage Ohio. Heritage Ohio's mission is helping people to save the places that matter, build community, live better. Today we have a presentation on lending for small businesses. I'm so pleased to have Erin Cornell from Economic and Community Development Institute, better known as ECDI, which offers both lending and technical assistance for small businesses. There are two handouts attached in the control box to your right, a copy of this PowerPoint and a handout which shows some of the documents required for lending with the ECDI, which Erin will be talking about. We will be taking questions at the end of the presentation. If you have a question, please type it into the question box at any time. Most issues with the webinar software will be solved if you close the program and restart it with the link that was sent to you. Later this afternoon, GoToWebinar will send out the link to the recording of this webinar. Our presenter today is Erin Cornell, Director of Community and Rural Lending at ECDI. He's a graduate of the University of Southern California and earned his law degree at The Ohio State University. With that, I will hand the presentation over to Erin.
Joyce, thank you so very much for the opportunity to be here. Thank you, Heritage Ohio. And as Joyce mentioned, my name is Erin Cornell with ECDI. I'm a loan officer, and I've been a loan officer with ECDI for about 2.5 years. And I've been with ECDI overall for 3.5 years. I put my contact information on this slide just in case you wanted to jot it down, but you also do have the slide deck there available for you. ECDI is a community-based lender. We're a micro lender and community advantage lender. Our mission-driven goal is to provide capital and training to small businesses so that as they grow, they can succeed and eventually go on to grow with bank and other conventional financing. And so at that time, we can reinvest those funds into additional growing businesses. As a loan officer, I work closely with clients seeking financing from ECDI, including reviewing business plans and financials, discussing strategies for success, locating additional resources at and outside of ECDI, and of course, working on loan-specific application needs. So I've seen a lot of businesses succeed here in my time at ECDI, and I've also seen a few that have not worked out and have struggled. COVID has certainly changed a lot of things about the way small businesses operate. But in general, I wanted to approach this presentation as an opportunity not only to talk about lending that's available, but some of the things, the factors that I've seen provide businesses success in my time here, and very recent examples of clients who have pivoted their business models in response to COVID. So as a quick outline, first I'll discuss some trends in business success through time. Some reasons businesses can face challenges. Then I'll talk about the factors that all lenders look at, the 5 C's of credit, things such as credit, collateral, and capital. And then I'd like to discuss how different lenders look at these various factors. So there's a spectrum of lenders out there, and it's helpful to know whether you're a business or someone in the community assisting businesses, what types of financing might be available. Then I'd like to talk about ECDI's specific lending programs and finish up with some client success stories. So I tried to make this as general enough as possible to be of interest to everyone, but also have some specifics for the different types of people that may be on the presentation. I'm going to try to keep this to 25 to 30 minutes, maybe a little shorter, maybe a little longer. And with that, I will begin. So as I mentioned, I've worked with many businesses over the past years, and I've seen some shift and change models. And I'd like to share some things that I've learned. From what I've witnessed, it's certainly one of the most challenging things you can do to have a small business and operate a small business, but certainly one of the most rewarding as well. Our economy depends on small business owners. It's one of the bedrocks of our economy and our country. So. But it can be challenging. So this first part here, I would like to discuss some data on business success rates and some criteria for succeeding as a small business. If you're thinking of starting a business, I hope you'll take this into consideration and really take advantage of the resources that are available, which I'll be discussing. And if you're an existing business, I still think this is applicable. And also, I hope you'll continue to take advantage of some of the resources for small business owners out there. So the next slide, this is some historical data on survival rates of new businesses over time. I actually recently saw this on a CDFA webinar, Council of Development Finance Agencies, from some data from Colorado. Colorado Main Street Loan Program had some Colorado data. I went and found the Ohio specific data and I really found it interesting. You know, you can see here businesses starting through time. So if you look at the top left, that blue line, you know, 100% of businesses starting in 1994. As you follow that line, you can see the number of businesses remaining through time. And I think that it really shows that business can be very challenging. So knowing that going in, you want to arm yourself with all the tools that you have to be able to succeed. Now, one thing I know that this doesn't include sole proprietors or sole member LLCs, so it is data for businesses with employees, but it really jumped out to me. We hear so much about challenges that small business face, and this really paints a picture, and you can see it's remarkably consistent through time. You know, we've had, in this time frame, had recessions, had booming economies, and the pattern is very clear. So I think, like I said, it helps to just arm yourself with all the information you have. And the other interesting thing is this is Ohio-specific data, as I mentioned, but it looks similar to Colorado's data, and I'm sure many other states out there. And I don't bring this up to be discouraging. You know, as I mentioned, I really just want it to be something that a small business owner would take into consideration. You know, because basically at the end of the day, it's not easy being a small business owner. Many of the clients I work with, you know, they're the boss, they're a manager, employee, they're the HR department, they're the bookkeeper, they're the frontline worker, the janitor, all at the same time. And so knowing some of those resources that are available out there is really important. So I wanted to talk about some of the reasons that businesses have faced challenges. And you can see the top two listed on this study from CD Insights. The first one being no market need, and the second being ran out of cash. Now, I will say off the top, this study also included technology startups, which banks and CDFIs like ECDI generally don't lend to. But I think the patterns and the trends there are pretty important. You know, for example, no market need. A business owner starting out or pivoting their business should really ask, you know, does your customer base need your good or service? Does your community need your good or service? And by need, I mean, does that community or customer base have the ability to sustainably demand the product or service over time? Because as you saw in that graph of business statistics, most businesses are going on for a number of years. But I think what happens is, and what I've seen with my clients is, after a few years, if the market hasn't been established, business owners will tend to say, hey, this is not working out. Second thing is cash flow. You know, it makes sense, that's obvious, but it's a huge challenge because there's so many unforeseen things out there that can happen in the world, just like COVID. So one thing to consider is that if you're thinking about financing, you know, just having enough cash to open the doors is not sufficient. You need to manage for uncertainties such as cost overruns, and then also have adequate working capital to get up and running until you are profitable. And I have seen a number of situations where you know, the door is open, but the client doesn't have enough capital working capital to pay for employees, inventory. So all of that needs to be taken into consideration. And those first two things, the reason I wanted to point them out that's essentially two things that lenders like ECDI both assist with the development of and also review very closely, and that's your business plan and your financial projections. Your business plan includes your market, the research that you've done, many other factors, your operational plan, and then your financial projections really look at the assumptions behind how you're going to earn a dollar and how much of that dollar you have left over once you've paid all your expenses. So the third thing too is wrong team. You know, sometimes entrepreneurs are really great at one aspect of a business. They might be really good at cooking food, but they might not have a very strong marketing background. So that's one thing to consider. You have to have all those factors in place, and sometimes it may not be you as an individual entrepreneur doing that. You need to know what other resources are out there, whether that's hiring a marketing person, for example, or hiring a bookkeeper so that you can stay current on taxes. You know, and as I mentioned, although this graphic is startup specific, you know, really any business at any stage in their life cycle will struggle if they aren't able to respond to the key things in a business plan and financial projections. So, you know, changing customer demands, you know, operating in a financially sound manner, and having the right people working in the business. I just wanted to give one quick example here of not my personal client, but another client of ECDI who I think did a really great job. It was a rolled ice cream store in Reynoldsburg, Ohio. Their grand opening day was 3 degrees outside. It was a couple years ago in January. 3 degrees for rolled ice cream, and they had 1,000 customers their first day. And they've expanded locations now. And that's a business that they knew what their marketing plan was. They had their operations down. You know, they spent time revamping them, making sure that when they did open, they could. And that, you know, they looked at all those aspects of the business plan and made sure they were all operating together, humming like a good engine. So some factors, I found this a website that had some information, and as I was looking through and trying to find some things that confirmed some of the thoughts I had about what successful businesses have done, I found this and I thought that it was really on point. So I wanted to share this with you. So key things that successful businesses do, you know, have a plan. As I mentioned, know how your business is going to make enough profit to sustain itself. So be a realist. You can't run your business on the best case scenario. So you have to have a cash buffer and expect that some things are going to be unforeseen. So make sure you have alternative plans and are realistic about, you know, what your customer base is, what your income potential is. Keep your expenses low. You know, you have to take more in than you put out. So try not to take on any expenses that you don't have to. And another key thing, absolutely build your network. So successful people know where to turn for help. So just a little more detail on these. As I mentioned, have a plan and be realistic. You know, that's really researching your market and putting together a solid business plan. And keeping your expenses low is also part of your business plan. But also, keeping your expenses low, I've seen a number of clients who have very successfully started out small and grown. For example, starting out with a plan that validates the need for the product or service, and then it allows you to test out your operations, and then expand if demand is there, and other success factors can be met. And I'll talk about one of my clients, Vision and Vasari, later on in the presentation. They did just that. They started out small and are growing even now during COVID. Also, it certainly helps to have an operating model that isn't highly leveraged, and that's something to consider when looking for financing. You know, how much do you really need to succeed? Because limiting the amount of debt keeps your fixed expenses low. Finally, build your network. I really think this is critical. So, there are many experts in every community. There's the Society of Retired Executives. There's the Small Business Development Centers, SBDCs. ECDI, we're a statewide organization. You have local economic development officials, but so much can come up during the course of a month, a day, a year, that it helps to have a network of supporters who can provide advice. And as this mentions, have been there before, most likely. Some additional suggestions that I kind of come across or wanted to mention, just some things I've seen from clients that have been really successful, is to know what you want from your business. You know, are you looking for a smart part-time side gig, or do you really want to create a multi-location, multi-state franchise someday? Something in between. That's really going to dictate, you know, what you need to look for. So you need to design a plan around that. So for example, if you're looking to do something on the side, a side gig, make sure it's something you really can do when you're part-time. It won't infringe too much on family time and free time. Or make sure that if it does take off, you have a plan in place to expand. You know, that's a good challenge to have, but it's one I commonly see where going from doing something for a couple hours a week to making a full-time business, that's where having that full business plan and financial projections are really critical. You know, if you want to own a multi-state franchise someday, know that you're going to have key employees that you can trust and who are competent to manage the business for you as you are growing. That's a challenge that growing businesses face. You know, if you're looking to operate a small business, maybe for example a restaurant, and just operate it, that's great. There are things you can do still to grow, and that's the second bullet I have there: constantly learn. Successful clients that I have and I've seen here at ECDI and elsewhere are always learning about their business and trying to improve operations. You know, for example, once you're up and running, what key performance indicators, KPIs, can you focus on this week or this month? You know, can you focus on increasing revenue per table, decrease employee turnover, reduce inventory costs? You know, what financial and operational goals can you establish this year? Because one of the things that I'm sure everyone on here knows is that events, everything, there's going to be things every day happening to grab your attention as a small business owner and take away from the bigger, higher level tasks. So if you're always looking at those higher level goals, putting them in place, you will improve your operation. So even if that's like I mentioned earlier, just a one restaurant with one location, you can still be improving year after year after year if you're working on that business. As I mentioned there, you know, seek to go from working in your business to working on your business, is sometimes to say. And you know, this goes for new businesses, seasoned businesses. One statistic I did want to mention, I think, really stood out to me. There's an organization called the Association for Enterprise Opportunity, and they work with microlenders such as ECDI around the country. They conducted a study and found that businesses that received capital and services from a nonprofit had median annual revenue growth 30% higher than businesses that did not. So the key part there being that the technical assistance and other training that led to increased revenue for those businesses compared to businesses who did not. And those are the businesses that are continually learning, establishing goals for themselves and reaching them, trying to always improve. So that was the proverbial iceberg, tip of the iceberg. It really was just a high level overview, but I wanted to mention those few things to, you know, provide a little background on why I think some of what we do here at ECDI is critical, and what some of our partners around the state, like SCORE and SBDCs, those services are so critical to small business success. That being said, lending is a huge part of what we do here at ECDI, and so that's what I'll be talking about next. First, over the next few slides, I'd like to talk about the various lenders that any small business might be approaching for financing. I want to talk a little bit about those different lenders at a high level, just to give you some information on what to expect and why different lenders have different policies and different approaches. Now, it's safe to say there's no cutoff line, there's no clear cutoff lines between a bank and a credit union and a CDFI, but there are definitely some areas that each of those organizations focus on, so I think it's good to sort of touch base. As I mentioned initially, there's a spectrum of lenders. You know, you have lots and lots of options. Obviously, banks have both conventional and SBA financing. Credit unions in your community might have business lending. Community development financial institutions such as ECDI, CDFI for short. As the name implies, they're community development financial institutions, but they're not necessarily banks. So have different programs and different services available. There are many city and county revolving loan funds available. There are other programs out there. So I think one thing, you know, it's helpful to think about the various stakeholders for each lender. For example, a bank, you know, a bank in your community, absolutely supporting small businesses in the area, but also have depositors as other stakeholders that they have to take into consideration. So that leads to a certain level of risk that a bank can take when it comes to lending. So I will start out, well, just to go back, you know, a community development financial institution, for example, has a mission of community development and financing small businesses. So it has a different approach to lending. And like I said, this is a spectrum of lenders, and many businesses through the course of their life of the business are going to have lending from all of these that you see here. So I'm going to start with conventional lending at banks. So as I mentioned here, banks usually have conventional and SBA financing. Conventional financing, conventional lending is bank financing that banks have for existing businesses with established track records, commercial real estate or other asset-backed businesses. Businesses that have been in existence 24 months or more. Now, certainly banks lend to startups, very, very common. Generally, that's when the owners have a certain level of personal liquidity, have a substantial equity injection, have a very high credit score. The SBA, Small Business Administration, and I'll talk about this in a little more detail, but ECDI is an SBA lender. Many banks are SBA lenders. Credit unions are SBA lenders. The Small Business Administration has several different programs that provide opportunities for lenders to lend, and then the SBA provides different types of guarantees. So, for example, there's a 7A guarantee program where the SBA guarantees a portion of that loan should the loan go bad. There's another loan program called the 504 loan program that's related to real estate, primarily real estate purchases. And then there's ECDI and other organizations that have other, like the SBA microloan program is something that ECDI has, which is another SBA program. And there's the SBA Community Advantage program, which I'll talk about as well. ECDI is a Community Advantage lender. So the SBA programs are government-backed programs, and a bank will have both conventional lending and SBA lending because the SBA requires what's called a credit elsewhere test. So whenever a bank or other lending organization uses a SBA product, they have to look at this credit elsewhere test, basically looking to have a reason why a business was not able to receive conventional financing. So, for example, in the case of a bank, for example, it's very common. Bankers, they know their conventional loan policies, so they might have generally not financed startups, so they would use SBA financing for that startup request. And so ECDI is another example. We receive the majority of our referrals from our banking partners because many of those banking partners know that those clients of theirs aren't eligible for conventional financing, and they may not have SBA financing, so they would send those clients to ECDI. I bring it up so that you have some information on when you go to a bank, well, why does this bank have SBA lending? ECDI has SBA lending. Because there's a different spectrum of lenders and what they're focusing on. So even with conventional lending and SBA lending, any organization can layer additional requirements on top of what the SBA requires. So the SBA has a very short and concise 450-page document, standard operating procedure document that contains all of their requirements, and that's the minimum floor for what the SBA requires. And I'll talk about some of those requirements. But for example, a bank can still include additional requirements. A bank might say, for our SBA lending, we want a certain debt-to-income ratio or certain credit scores. We want to have a 680 or 720 and above. Certain SBA scores, which is a score that the SBA develops based on client information. Other background items, the SBA, a bank may have SBA lending, but still not. You still may not qualify as a business owner because you don't meet the bank's requirements for that SBA loan. And the same thing would go for credit unions. But again, as I mentioned, think about the stakeholders of each organization. Credit unions have members, so if they have business members, they are really focused on their membership. I did want to mention one thing. Banks and credit unions also are going to provide services that other organizations like revolving loan funds, CDFIs like ECDI don't provide, such as business checking accounts, savings accounts, payment processing services, point of sale systems, credit card processing. Those are all things that are critical for the operations of your business in some cases, that even if you were to receive financing from an alternative lender, you're still going to need to have a relationship with the bank. And as I mentioned, we get the majority of our referrals from banks and have really appreciate those relationships. And one of the reasons is, business still needs to have many of the services that banks offer, including, also business credit cards and some things that might be of benefit. So moving on to CDFIs, as I mentioned, community development financial institutions are community-driven organizations that can focus on many different types of businesses. There are some CDFIs that focus on real estate, some that focus on consumer lending, and many that focus on small business lending. And that is exactly what ECDI does. We do that through multiple different programs. We have the SBA microloan program, USDA microloan program, SBA Community Advantage program, and one of the things, another factor to consider, there's different SBA programs at different types of organizations, is the Community Advantage program is a much smaller program. It's designed to be up to $250,000, whereas bank SBA financing programs can range upwards of $5 million. But really, you have options, and it's really going to depend on what you need. County and city revolving loan programs, as I mentioned, are all over the state and could be a really great source of additional financing. A lot of times they need to have another lender that's involved, often not. Sometimes they have job creation requirements or other requirements. So some considerations, when thinking about, okay, I need some financing, where do I start? Well, as I mentioned, you're always going to want to have a relationship with the bank. You're going to need them for checking account and other services. But some things to consider, what type of, or what size of loan do I need? Do I need a $2 million loan or a $30,000? What term am I looking for? Type of product. For example, banks may have lines of credit that you can access when needed, but not always have on your books paying interest when you don't need them. That's not something that ECDI offers, for example. We have term loans only. A small community bank may be a better fit for your type of request than a large regional bank. Or on the other hand, a large regional bank may be better, just depending on the size, the financing need, access to additional banking services that you need. One thing to consider is the term, as I mentioned. A bank may offer a 5 to 7 year SBA loan term, but ECDI, for example, our Community Advantage program is a 10-year term. Our microloan is a 5-year term. Our Community Advantage program is a 10-year term. And one final thing I want to mention is that many times different organizations will work together. So for example, I have worked on large requests that involve a bank, another SBA lender, ECDI, and a county revolving loan fund. And that's where having those connections with your community leaders, economic development officials who can talk with all the different parties can be really useful. That, for example, was in the Lima area, and it was the person coordinating worked for the county, and that was a great way to bring all the parties together so that we could put together a financing package that otherwise would not have happened for that borrower. Now, next thing I want to talk about is, and I will mention, this is the first time I've given this presentation, so I'm hoping this analogy will work and make sense, but bear with me. So any lender is going to make a decision on similar criteria. They might have different weights, and the criteria might have different importance, but when looking at that, it's called the 5 C's of credit, and kind of want to make an analogy to a 5-legged chair. Here, if you look at that, if one of those wheels wasn't working, the chair might roll. If 2 were not working, it probably wasn't going to move very much at all. So every lender is going to look at 5 different areas: a borrower's capacity to repay a loan, their character, the collateral available to secure the loan, personal capital a borrower is willing to put into the business, and the economic and competitive conditions a business will face. Now, I'm not saying you can walk into any bank and say, or any organization say, well, I need to see your 5 C's template. It's not like that. It's really, these are just, as you can imagine, these are broad categories that when you're extending credit, you look at to determine repayment ability. Because at the end of the day, all lenders want to get repaid. In spite of the differences in credit requirements, collateral requirements, every lender is looking to get repaid because that's how they, in the case of a CDFI, for example, that's how they re-lend that money out to increase job creation in the community and repeat that cycle. So, as I mentioned, the 5 C's are character, capacity, collateral, capital, and condition. Just very briefly, character includes experience in the industry, but it also is heavily focused on personal credit history. Capacity is the financial capacity to support the debt and other expenses. So, as an example, are you generating $1.20 to $1.25 of income per dollar of debt service? So that $1.25 is what's left over after all expenses except for debt. And does that equal $1.20 or $1.25, $1.25? Because a bank or a financial institution wants to see some margin of safety there. And that goes for existing businesses. For existing businesses, does past performance show that ability to cover debt? For startups, are projections reasonable enough and still provide that margin of safety? So some lenders will look at projection-based requests, others won't. But in either case, even if they're looking at projections, a lender will want to see that you're projecting to generate enough income. But it has to be reasonable, and that's where understanding the business plan and the assumptions behind the business plan really come in. Collateral, business and personal assets that can act as a secondary source of repayment if business cash flow does not cover debt payments. Makes sense? Capital, this is another key thing, and I'll talk about some of the differences. How much are you able to put into your business? And then conditions, what industry are you in essentially? And what's the risk level of that industry? I just noticed that's 135, so I will pick it up here. So I wanted to go over a little bit more detail on the 5 C's. So if you're working with, if you're a business owner thinking about asking for a loan, there's some things you can do to maybe improve your chances. Look through your credit report, for example, see if there's anything you can clean up. But if you're also working with someone in the community who's going to be requesting credit, these are the things that you can talk about with them. So credit requirements will vary by institution. Banks may require an average or above average credit score. And sometimes 1 or 2 minor blemishes can disqualify you from bank financing, particularly on what are called scored loans. But it really depends on the bank and the relationship you have with the bank. But sometimes that if you do have some credit blemishes, that will lead a bank to using SBA financing, I discussed earlier. A recent bankruptcy, for example, discharged 7 years or less, is probably a good example where a bank would look at SBA financing. Community-based lenders are generally more flexible with credit. So ECDI, we are frankly really flexible when it comes to credit, and I'll explain some of the specifics of what we look at later. But CDFI is generally looking at an explanation for a credit score. If your credit score is lower, why is that? Can we see some medical collections, for example, or was there a bankruptcy, 3 or more years ago, but you've established your credit back. You've shown that you've been paying bills on time, those kind of things. So on the capacity side, different institutions will certainly have different requirements for historical coverage of their cash flow coverage. So, if you're looking for conventional financing for an existing business, that a bank's going to look at what cash has that business generated in the past. If you're looking at a startup, what cash flow is projected, and then, one of the things. This is why I wanted to talk about and use that chair as the 5-wheel chair as an analogy. But one of the things that makes ECDI do what we do as a community-based lender is there are some industries, for example, that are riskier, and so someone might have good credit but might have projections. So as I mentioned earlier, most likely if it's a projection-based request, you're looking at SBA financing. But let's say it's a restaurant, a startup restaurant. It's known to be a riskier industry. That's where you're looking at a couple of those 5 C's aren't as strong as a traditional bank might want, and that's where a client would come to ECDI. Now our goal would be, and this is the key point about organizations like ECDI, is that we look at it as there's an opportunity. It might be a riskier industry like a restaurant, but there's opportunity through technical assistance and training, constant KPI improvement, to really succeed. And then in a few years, as that restaurant grows to its 2nd and 3rd location, they can go and get bank financing. And that's our happy moment. That's what we really enjoy and want to see. I want to bring that up as an example. Collateral, for a conventional financing, you're generally looking at needing around 100% or more collateral coverage. And remember, any lender is going to look at the value of the collateral and discount it, to account for the fact that it might be liquidated quickly. The SBA, for any of their loan programs, requires that that lenders take all available collateral. That includes personal and business collateral. And what I mean by personal collateral, for example, a good example would be if you have a home, personal property, just land or a home that has 25% or more equity in it. The SBA requires that a mortgage be placed in the amount of the loan on that property as collateral for the loan. For startups, so capital is really equity injection. How much are you personally able to put into the business? Banks might require, for startups, for example, 20% or more. 10% is the requirement for SBA lending. And one thing I wanted to mention is that financial companies look at a project. So if you have a $200,000 project open a location, open a small factory, for example, and it's $200,000, and you want to open that, or you know that all the expenses that you need are $200,000. Well, if you have a 10% equity injection requirement, that means the loan would be $180,000, and your personal contribution would be $20,000. You know, if you're looking at 20% equity injection, well, you would need to bring $40,000, and the loan would be $160,000. So that's one thing to consider, is what is your ability to bring that equity injection. Like I said, SBA requires 10% equity injection on SBA loans. Conditions, I kind of talked about this, so I'll briefly mention, you know, there are some industries, particularly cash-based industries like restaurants, retail establishments, that don't have receivables that can be used as collateral. Those are more likely to be SBA lending at a bank or with ECDI. One real quick note on, is taking on debt the right thing? You know, it's really, this is something to talk with your business advisor and accountant about. But to just bear in mind that, you know, if it doesn't work out, if the business doesn't work out, even if you close the business, you generally are still signing a personal guarantee and are going to owe those funds back. You have to repay that loan. So some things to consider, I mean, some things that are positive. You know, if you've put a significant amount of personal financial investment into a business, well, you can leverage that with loan financing. Interest payments may be tax deductible, maybe less stressful than borrowing from friends and family. And the other thing is that debt is amortized, which means as you're paying that loan off, you are that capital that's on your balance sheet now becomes, you know, equity that you have rather than a debt on your balance sheet. All right, so getting to what ECDI can do for you, I really just wanted to give a brief overview of what we do. So we are one of the top SBA microlenders in the country, and we're also the only SBA microlender in Ohio since 2004. We're a CDFI, as I mentioned, specialized in affordable, responsible lending. And our model is educate, invest, and innovate. We provide entrepreneur training, mentoring, and access to capital. And one thing I wanted to mention, you know, we try to be very responsive to the needs of our borrowers. Since March, for example, we've tripled our loan output to help, you know, small businesses impacted by COVID. Cash flow has been the #1 concern, as you can imagine. And, you know, of course, we always want to make sure that it's a good idea for additional financing. A lot of this isn't just about tripling our loan output, it's also about working with our clients on pivoting their business loan model. What are they doing to respond to COVID, so that it's not just, you know, another month of paying employees, it's switching that business model around to be successful even in these unprecedented times. So, you know, our mission essentially is to invest in people to create measurable and enduring social and economic change. Types of loans available. So here we're getting into the types of loans that ECDI has, and after the program, I'm happy to answer any questions you have. So let me know. But our microloan program is we primarily use SBA microloan dollars, but we also have other programs like USDA, other county and city funds available in different areas. But for startup businesses, we lend up to $75,000, existing businesses up to $350,000. Our minimum credit score is 590. As I mentioned, we're looking at the story, the reason why our credit score is where it is. For our microloan program, I'm sorry, that should actually say 60 to 66 months. So it's actually 60 to 66 months. No prepayment penalty. Rates can vary from 7.25% to 12%. Closing costs can vary from 1% to 5%. And eligible uses are nonprofit businesses and real estate transactions. So real estate purchase and construction. So a few things there. I wanted to mention, you know, as EC, we're not a bank, so we definitely have different funding sources than traditional banks and other, you know, lending institutions. So We combine, in any given loan, we're combining multiple funding sources. It's often based on geography or other eligibility determinations. And that's why our interest rates can vary. And one thing I wanted to mention too is, our rates are certainly slightly higher than banks, and in general, and I hope I've explained some of the factors for why that is the case in the previous few slides. But when looking at microlenders like ECDI around the country, ECDI is right in the middle, if not better, in terms of rate and in term and closing costs and those things. One thing to take into consideration is that we have a different client base. We have different risk profile and different costs of administering some of these government programs. So on our microloan program, it can be used for, like I said, anything but nonprofits and real estate. There are some prohibited categories as well. It's a federally backed loan, so there's some federally prohibited industries. But, for example, a startup in if you want to lease a space to open a boutique and need some funds for inventory, for leasehold improvements, to work on some of the plumbing, those kind of things, working capital to pay employees, those are all good uses or eligible uses for microloans. Our collateral requirements for our microloans are very flexible. We will still take all available collateral, but really have, particularly for loans 50,000 and under, have very flexible credit requirements or collateral requirements. I mean, we're looking to see what's available, but we're primarily, as a CDFI, primarily looking at what is this business, what's that owner's experience, what's the business plan, what's their plan to succeed, are they willing to continually improve the business, take educational courses, those kind of things. Moving on, another program we have, it's really just the microloan program, but it's a scored program, up to $20,000. And the requirements generally are a qualifying credit score, so as I mentioned, 590 or above, and then SBA eligibility. And I'll talk a little bit more about that later. But this is a great program. It's a quick process. It has 3 or 4 documents that need filled out, and it can be a great option for some borrowers in need of working capital. I just wanted to give you an idea. I mentioned we tripled our loan volume. We had a recovery loan program it's ended now, but that was our response to COVID, particularly for borrowers who were not able to receive PPP or EIDL funding from the SBA. We really filled in the gap there for a lot of small businesses around the state. Right now, we have a rebound loan program in Cuyahoga, Franklin, and some counties actually in Kentucky. And if I didn't mention, ECDI can lend in all 88 counties in Ohio, as well as a few counties in the greater Cincinnati metropolitan area. My favorite loan program is the Community Advantage program. I really enjoy it because it is a 10-year term. We can work with both startups and existing businesses up to $250,000. So even if you're a startup, because of the SBA guarantee, we're able to do that. So some common uses are loans for inventory, equipment, and working capital. Requirements are qualifying SBA score, and the rate is prime plus 6% and a maximum of 5% of the loan amount. So very briefly, I'm going to switch here to the loan information requirements checklist. Now, I know at first glance this is going to look like a lot. Well, this isn't, not every loan requires everything on this list. This is a checklist that I use with a borrower that's coming in and requesting a loan, and when I know what size, what type of loan they're requesting, then I have I can check off the boxes and send them home with a list. But just to give you an idea, you can see my mouse here, there's our application materials that we provide. We're looking for a business plan and cash flow projections, If it's an existing business, financial statements and existing tax returns, equity injection for startups, some other things. We need that legal entity information for LLCs or S or C corps. And then what we're collecting from borrowers is that information on what they're trying to finance. If they're looking to purchase a business, do we have a purchase agreement? If there's a franchise involved, do we have a franchise agreement? If there's going to be construction or equipment, do we have equipment purchases? Do we have quotes for that? And then just real quickly, some challenges to receiving SBA funding. As I mentioned, it's federal in nature. So you're dealing with a federal agency, so they're coming up with rules that are based off of that. And so if someone has past due or charged off federal debt, such as student loans or federally backed mortgages, that can be a challenge. If you think that's the case, let me know and we can talk about it. Because maybe there's, maybe you're on a payment plan, or maybe it's something that, maybe it's a student loan that actually wasn't federal, for example. Past due taxes or tax liens, especially payroll taxes and sales tax, because those are held in trust by a business. And then crimes involving dishonesty, especially financial nature, can potentially rule out someone from receiving SBA financing. And other requirements, as I mentioned, owners with 20% or more ownership. As I mentioned, equity injection is 10%. One other thing is, any owner with 20% or more that owns 20% or more of the business must guarantee the loan. So if it's a single owner LLC, for example, that person clearly is going to need to guarantee the loan. But if someone owns 20% or more, 25% of the company, if they don't want to be on the loan, well, unfortunately, they're going to need to, or something would have to change with the structure of the business. A few more things about ECDI, how we implement the education and training. One factor is through, or one manner is through the women's business centers, open to all entrepreneurs, not just women, of course. One-on-one business coaching, trainings, and kind of the trainings rotate throughout the year. So as an example, during the first few months of the year, there's going to be some classes on tax strategy to help you think as a business owner, how I'm approaching filing my taxes, how do I think about that? Right now it's a little tough because of COVID, but there's a computer lab, there's networking events, there's a professional advisor network. There's actually a membership fee of $80 for the Women's Business Center, but it's really small, a small price to pay. When you think of, you get Wi-Fi, co-working, space to work, compared to what you'd be paying for some other spaces around. If you were just had your own space that you were paying a lease for example. A few other programs. We have a food fort in Central Ohio here. But I wanted to mention it because if you're thinking of starting a food-based business or working with a food-based business, we have retired City of Columbus health inspector on staff who would be very happy to either meet with you or have set up a phone call if you're anywhere in the state to discuss some of the licensing requirements that you might face, the process of applying for license, the health license, food license. We also have our food fort director who has decades of experience in food-based businesses, and would also be happy to talk about strategy, licensing, operations of a food-based business. The Capital for Construction program is short-term project financing for subcontractors, primarily MBE and EDGE contractors. And then rural lending is what I focus on. And finally, one thing I really, really like here is an online portal we have called Initiate Prosperity. It has, as you can see on the top dark bar there, COVID-19, money, marketing, and management. There's 4 different areas of things that are available. So if you were interested, you could have 24/7 access to these resources. There's over 100 interactive tools, templates, videos, and guides, expert training and videos. And then there's also, if you see up top, contact a coach, there's an opportunity to talk one-on-one with someone about some of the modules. So, under money, there's budgeting and forecasting. Marketing talks about marketing, but also digital marketing, Facebook ads, Google AdWords, those kind of things. Management, I actually put up the cybersecurity example here under management because of a client of mine who recently had a website that was bot hacked. And it was something that I hadn't heard about. It's a very real thing that businesses face if they have a website. So we only have a few more minutes left, and I wanted to go over just a few clients of mine, just to give you some success stories. These are clients I've worked with. We financed 1487 Brewery in Plain City. This is actually an example where they had received some financing, an SBA loan to get started, and then once they started construction, the community came out and said, hey, there are no food options available here. Can you also add a restaurant? So they came to ECDI, we got them financed, and they are about to open late September or early October here. And one of the things I learned from Ben, who's the second gentleman on the right there, take your time planning, but strike when the iron is hot, because he spent years planning to be successful, brewing those recipes, developing the recipes for the beer. And then once he found the right location, he really snapped. Rodney Robertson in Marion, Ohio, works at Poppin Rollin, and he has gourmet popcorn and rolled ice cream. And I think this is a really great example of a microloan. So Rodney had worked at a location at the mall in Marion and wanted to move to a more visible location where you get some higher foot traffic. So, provided a loan for a brick and mortar shop, essentially, to build that out, some working capital, additional inventory. And he is about to open that second location any day now. Another client I've worked with is Sherry Long of Access Title Agency. She worked at a title agency for 15 plus years and then said, hey, I can do this myself, and basically needed some working capital to start up. And now, this was just a couple years ago, but now has 3 offices in the central Ohio area, New Albany, Madison, and Newark, and is very successful. Last one, as I mentioned, Vision and Vasari, Alyssa, Hicks, and Mo, down in Asheville. She started out, when she first came, she wanted to get a location and build it out. And this was in the spring, and I said, hey, let's look at this. Maybe you can start smaller, because we don't really know what the next few months are going to look like. And it really worked out well for her because she established her brand. She's had some very successful estate sales, working capital, and now we'll be expanding to a brick and mortar location to grow her business. So I went much longer than I expected, so thank you for your patience, and I hope this was enjoyable and helpful. And if you have any questions, here's my contact information. Please don't hesitate to reach out at all, and thank you very much. Joyce?
Thank you, Aaron. Please type any questions you might have in the question box. We have one that came in earlier. Is proof of concept ever necessary?
So for a, I know that term in the context of maybe more of a technology startup or idea stage business. The loans that we're talking about are primarily not geared towards technology startups, idea stage businesses. I mean, they're really more for Main Street service sector businesses or small manufacturing, because taking on debt is more appropriate in that situation, because there's an established cash flow either with an existing business, either established cash flow, or even for a startup, it's a business model that is understood. For example, it's going back to the restaurant example. You cook good food, you're in the right location, people come, and you can repay them. So to answer the question directly, I would say maybe you can reach out to me and give me a little more context. But if the question was regarding more of a tech-based company, it probably is not the right fit for bank or CDFI debt financing. And I can say we've worked with technology companies and other companies once they've gone beyond that proof of concept phase and are generating revenue, but simply to develop it probably is not going to work out.
All right, thank you. Another question was about handouts. Again, in your control panel to the right, there are 2 handouts. You should be able to download them from the panel. If you can't get them, you can email me and I'll be happy to send them to you, email. Another question, can you explain the wrong team reason for business failure? I think it was reason number 3 in your reasons for business failure.
Oh, wrong team. Just
Yes.
explain that a little bit more. Well, what I meant there, it's really context specific. But for example, if you are looking to expand, to multiple locations, you need to have someone you can trust manning the ship while you're out doing, starting another location, for example. So you have to have not only the right operations, but the right people in place. I had a client, just as an example, who started out as a small cottage manufacturer. He had some very artisanal folks on, that were helping him out, but he grew very quickly, faster than he expected. And those people that he was working with weren't the right fit anymore. He needed someone who really understood that it was a business, not just a craft. So that's about the best example I have, but really finding the right people for all aspects of your business. Like I said, if you're not good at marketing, well, maybe you need to hire someone to do your marketing for you. Or if you are, not comfortable doing some of the, one common thing I see all the time is people get behind on taxes, whether it's payroll. And you get a tax lien, you get a state tax lien or a federal tax lien. You don't pay your business taxes, and that's really not a great place to be. So having that person on your team who can do that, or who is someone you hire outside, third party, is really critical. Unfortunately, sometimes I've seen it myself with some of my business owners. Staff member, if you put too much trust in someone, they can take advantage of that. Whether it's frontline server or it's your controller of your business, sometimes people can take advantage and even steal from the company. So those are all things that unfortunately you have to look out for. But hopefully that's a little helpful.
All right, we have another question. I started an insurance agency right before the pandemic. I didn't plan on needing working capital since I was working from my house and had the equipment. Now I'm having issues getting clients online without paying Google. My credit is awful. Is there any help for someone like me?
Well, I think I would need to speak with that person, to understand what he or she needs about credit, other things, because we do have our minimum requirements, but they're very flexible. So I would ask that person to just send me an email. I'll take a look or talk with them about their business.
Great. So everyone feel free to contact Erin directly. Don't be shy about that. Do we have any other questions coming in? I think the takeaway is ECDI has more flexibility than you might anticipate. So try rather than not try, right?
Absolutely.
Well, I see no other questions coming in, and we're certainly at 2 o'clock. I would like to thank Erin and everybody at ECDI for the wonderful services you provide to Ohio small businesses. Really do check out their technical assistance and educational programs because constant learning is important. Heritage Ohio's next webinar will be October 6th with Christy Tanner from Jobs Ohio explaining their new program, Vibrant Communities. So I hope you'll all look for joining us with that community and check it out on their website in the meantime. Thank you very much, Erin, and please contact us if I can do anything for you.
Thanks so much, everyone.